So let's assume that you want to buy a G-Wagon, but you don't make $100,000 a year. You only made $25,000 a year. Now, I'm not going to recommend anybody do this. I'm just talking about how the taxes work, and I'm talking about how debt works when it comes to taxes. Okay, so take this for what it's worth. You made $25,000 this year in your business. Nice. Now you want to go out and ball out with a G-Wagon, but you don't have $100,000 to buy this G-Wagon with cash. So what do? You put down $20,000 to buy this $100,000 G-Wagon, and you finance the other $80,000. Now, you will get that same $80,000 deduction. But how are you going to write off $80,000 of a deduction when you only have $25,000 worth of income? Because now you subtract this $25,000 that you could, now you have $0 of taxable income, but you still have a lot of money left over in this deduction. Well, now you have a loss, because now you get to tell the IRS, okay, I didn't actually have any taxable income. In fact, I had a $55,000 loss in my business because, well, I had to go out and buy this G-Wagon. Now again, this doesn't mean that you have negative $55,000 in your bank account. You still have $5,000 in your bank account because you financed this G-Wagon. So you have $5,000 in your bank account right now. You tell the IRS that you have a $55,000 loss because you could deduct 80% of the value of this G-Wagon. Now, next year, you might make a little bit more money. Let's assume next year that you made $35,000 in your business. Nice. Well, now you tell the IRS, hey IRS, I made $35,000 in my business this year. But last year, I lost $55,000. So now you deduct this against this, and again, you have $0 of taxable income. Because now you had $35,000 of profit, which is in your bank account. This plus this means you have $40,000 in your bank account. But again, $0 worth of taxable income because you get to carry forward this loss. Then the year after that, you get to take the leftover from this loss on your income again. Now you can start to see how some business owners will be able to use debt strategically to carry forward losses against their income. And this can get much bigger when the dollars are bigger too. It doesn't have to be cars. It doesn't have to be planes. You can buy machinery. You can buy other equipment for your business. You could potentially buy real estate strategically. There's other rules with real estate, which will now allow you to deduct the value of the asset that you bought from your income. Show a loss on taxes, even though you have cash in your bank account, even though you're making a profit on paper. You have cash. You're making a profit, but you have a taxable loss. And now you can take this taxable loss and move it forward every single year, as long as the IRS said so. But you can keep moving forward this loss, which means you make a profit. You have more cash in your bank account, but you owe no money in taxes legally. Let me give you another fun example. Let's assume that you made $2 million this year from your business. This is the profit. This is the cash in your bank account. Now, if you just left this money as it is, you don't have any other deductions, you're going to have a pretty big tax bill because if you have $2 million of income, that's a big tax bill. But now, if you were to go out and buy, let's just say, a $20 million plane, well, now, what are you going to do? You're going to put down $2 million to buy this $20 million plane, and you're going to finance the other $18 million. So this is $18 million worth of debt. And now the IRS has some special tax provisions on planes, which will allow you to deduct pretty much the entire plane this year. Which means now you get to tell the IRS, hey, I made $2 million minus these deductions, which is this $20 million plane that I just bought, even though you only put down $2 million. So that means you have negative $18 million in taxable income. Now next year, if you made $4 million, you just carry forward this loss. And the year after that, you can carry forward the loss again. And you do that again and again and again. And then maybe you could sell this plane for $20 million. Maybe you sell it for a profit. Maybe you sell it for a little bit of a loss, but you're making money every year and you're paying little to no money in taxes. And this is completely legal. Again, this is why it pays to have a good accountant. Now, this doesn't mean you have to go out and buy a plane. This doesn't mean you have to go out and buy a G-Wagon. There's so many other ways to do this. Just planes and G-Wagons are fun to talk about, but there's so many other ways to do this, which is why you want to make sure you have a good accountant on your side. That way you understand the different deductions that are possible. That way you can actually use them. This is what strategic tax planning is, because tax planning is all about understanding the different ways that you can spend money. That way you can have cash in your bank account and pay little to no money in taxes legally. Now, of course, when it comes to debt, you have to understand debt comes with its own risks. Our economy goes through highs and lows, meaning you have to predict that there are going to be times where your business will also go through highs and lows. And so if you use debt, you have expenses that never go away. And so you have to factor that in there. So don't just go out and take on a whole bunch of debt because, well, you don't want to pay any money in taxes. Understand the risks with that, because debt has its own risks. This is where you want to be financially smart, but then you also want to be tax smart. That way you can pay the least amount of money in taxes legally. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.